You've probably seen inflation mentioned a lot in the news recently, but what actually is it? The inflation rate is the measure of how much the price of products or services have increased over time. For example, if a loaf of bread costs £1 today and £1.05 next year, the annual bread inflation would be 5%. To work out the inflation rate, the Office of National Statistics tracked the prices of everyday items by creating an imaginary basket of goods. This basket changes every time in response to the British spending habit. Last year, men's suits were out and meat-free sausages were in. This is known as the Consumer Price Index, or CPI. You might also see it as the Consumer Price Index including housing costs, or CPIH. Catchy, right? If the inflation rate is going up, it means that everyday goods and services are becoming more expensive, from buying your weekly groceries and filling up your car to paying your mortgage. This can be good for savers because they can earn more interest on the money they put into savings accounts and current accounts. But for borrowers, it can lead to higher borrowing costs, making their debts more expensive. When inflation rises drastically, the Bank of England looks for ways to reduce it. One of the most common ways is to increase the base rate. This is the rate the Bank of England charges other banks and lenders to borrow money. The Bank of England does this to try and stop consumers from spending and borrowing so much. When people spend less, companies can't increase their prices so quickly. This should, in theory, reduce inflation. When the base rate rises, this tends to influence mortgage lenders to increase their own interest rates. If you already own a home and you have a variable rate mortgage, it's likely you'll see your mortgage payments increase almost immediately. While for first-time buyers, you could find it harder to get a mortgage due to lenders' affordability tests, which can become hard to pass when mortgages are less affordable. Homeowners wishing to move house or change mortgage deals can be affected too. If you are hoping to sell your home to buy a bigger property, the higher cost of borrowing may make it difficult to take out a larger mortgage. While if you are coming to the end of a fixed rate term, remortgaging onto a new deal may be trickier if current interest rates are significantly higher than they were when you were looking to take out your mortgage originally. If you're struggling to get the mortgage deal you need, it's always worth seeking expert advice. Here at Tembo, we are experts at helping people overcome this exact problem. Create a mortgage recommendation online and discover your buying budget from a range of over 100 lenders and specialist buying schemes. Once you're ready, speak to our award-winning team to scope out the right mortgage for you. Head over to tembomoney.com to get started.